Continuing on with Chapter 6, in our second video, we're going to talk about a bank reconciliation. And what a bank reconciliation does is it proves the cash in the bank is equal to the cash in our cash account after we've made any of the adjustments that we need to make on our bank reconciliation. I don't know about how many of you have checking accounts. Maybe some of you do. Many people now use just a debit card. But if you use, and all businesses that have a checking account will have to do a bank reconciliation. And a bank reconciliation is basically broken down into 4 items. On one side, we have the bank balance per whatever the bank statement is for the end of the month. And we add items, usually on what they call timing differences. On the cash books, this is the cash balance per our accounting records, and we add some timing differences then as well. So the type of timing differences that we add on the bank side is what they call a deposit in transit. If any of you have ever gone to buy a bank, and on the side of the wall you see a metal plate and it says night depository in it. Well, this is where, if we follow the rules that we looked at in the last video about depositing our cash intact daily, we know that the bank might close at 5 o'clock. Our business might not close till 8 o'clock at night. And so on the last day of the month, this is when it usually occurs because the other days are okay, but like the last day of the month, bank closed at 5, you don't close till 8, you have your cash receipts for the last day of the month. What happens to them? Well, one of 2 things. You're either going to have a armored car service come by and pick up the money, or one of your employees might take it to the bank, open the night depository door, drop in your deposit, goes down into a vault in the bottom of the bank. And when are they going to open that? They're going to open it the first day of the next month. But if you're making your deposit, that deposit for the last day of the month is already in your cash balance, but it's not in the bank balance. And so we're going to have to add in that deposit in transit. That's why they call it a timing difference. I look at it something the same way, but basically that deposit in transit is something that the company knew about on the last day of the month, but the bank did not know about it on the last day of the month. Okay, I'm going to go down. Oh, we'll go over here. What we add back for a timing difference as far as the cash account is concerned is lots of times banks act as a collection agency. So if the company's loaned money to someone, and maybe they're in San Francisco and you're here in Fresno, so they go to the bank in San Francisco and they pay off their note to you plus the interest. And if it was the last day of the month and they haven't recorded it yet, then basically the collection will be here in the balance from the bank statement. But since we didn't know about it until we got the bank statement, it wouldn't be here in the cash books. So we have to add back that collection of the note receivable plus any interest that we would have earned on this particular note receivable. Okay. We deduct for timing differences on both the bank side and the book side. Most of us have these occasionally, and they are outstanding checks. And what do we mean by outstanding checks? Well, checks that we've written, taken out of our checkbook, our cash account, but it hasn't cleared the bank yet. So you write a check to someone on the last day of the month and you put it in the mail. They're not going to get it the last day of the month. They're not going to get it for however long it takes the post office to be able to collect and it to be cleared. Okay, So we list our outstanding checks, and normally we list each one separately. Okay, because we've already taken out of here, so to get the adjusted bank balance, we have to take it and take them off of the bank side as well. We also have some deductions as far as timing differences are concerned on the cash side, and those could be like a service fee. Many banks don't charge them. Some banks do charge different types of service fees. We don't know about them till we get our bank statement, so we haven't deducted them from our cash account yet, but we have to deduct them to get our bank's reconciliation in balance. Lots of banks charge for check printing. Again, if you get your checks, but you haven't seen how much they're charging, you have to wait till you get a memorandum from the bank, but more likely it's going to wait until we get our bank statement in, and it's going to show up there. The last is what they call an NSF check plus fees. And NSF check stands for non-sufficient funds. So somebody gives you a check for $100. You take it to the bank. You deposit it in your checking account, thinking all is well. The bank goes to the other bank to try to collect that $100. Nope. That account's been closed. It doesn't have any money in it. And so you're going to be notified that you have an NSF check. Remember, it's already been deposited up here, but it didn't clear the bank. And so the bank is going to charge you back into your account, take the money out for the NSF check, plus probably charge you a fee for doing it as well. When you do everything you need to do, and the only thing I didn't say could come up here in the bank statement are bank errors, and they go on the bank side, and book errors go on then the book side, and you have to decide whether it's an addition or a subtraction. So could be maybe the bank cleared one of your checks. It was $109.57, and they cleared it for $109.59. They took too much out. So you're going to have to add that error back in. The same is true over here. Maybe we wrote a check for $152. It was written for $152. We gave it to the person we owe the $152 to. They deposit it in their bank. Our bank takes $152 out of our account, but when we recorded it in the books, oops, we made a transposition error. We only took out $125 out of our account. So we have a transposition error, so we would have to deduct the difference between the $152 and the $125. We're going to have to deduct that $35 out of our account under deductions from our bank. Each error is looked at separately to know in which of the categories then we're going to have to record that amount. Okay. Once you do your bank statement, the adjusted bank balance has to equal the adjusted book balance. Okay. After you're finished, anything that you find on the bank side, you just leave it alone. The likelihood is your deposit in transit at the end of this month will show up as a deposit next month when they deposit it the following day. Outstanding checks, most of them eventually will clear. If they don't clear, then you're going to issue a stop payment on that check. You either reissue it or find out what you need to do about it. The book side of our bank reconciliation is different. Anything that you put on the book side of your bank reconciliation must have an adjusting journal entry. And so if we did a collection, we'd have to record the adjusting journal entry for our collection. We'd have to record the expenses. We'd have to put back our NSF check into our receivables. So anything over here, whether it's these type of things that we know about, collections, service fees, or whether it's an error on our part, if it's one that we have, anything on the book side will require an adjusting journal entry. So what I thought I might do, if you will look, got to get back over there. Now we're not going to do a real long one, but we're going to do then exercise 6-11 on page 308. And so I basically have started it. Okay. So I'm looking at exercise 6-11 on page 308, and this is Wright Company's bank reconciliation for the month ended May the 31st, 2017. And so it tells us Wright Company deposits all cash on the day when they receive it, and it makes all cash disbursements by check, all cash payments. At the close of business on May 31st, its cash account showed a $27,500 balance. So we're going to start this with a $27,500 balance, and the company's May 31st bank statement shows $25,800. So they only have $25,800. So it appears that we're saying we have more money than what the bank says. Okay. The first one on A says the May 31st bank statement lists $100 in bank service charges. The company has not yet recorded the cost of these services. So we're going to have, I'm just going to write it in as bank fees. And that's going to deduct then $100. And this was A. Number B says outstanding checks as of May 31st total $5,600. And so we have outstanding checks. Well, how much was that now? $5,600. Number C, May 31st cash receipts of $6,200 were placed in the bank's night depository after banking hours and was not recorded on the May 31st bank statement. And so number C is our deposit in transit. And remember that deposit in transit, that C, for $6,200 has already been recorded over here. Number D, in reviewing the bank statement, a $400 check written by Smith Company was mistakenly drawn against Wright's account. Well, we didn't do anything wrong, but it sounds like the bank did. So we're going to do a D here, and that's going to be a bank error. And it says that a $400 check written by Smith Company was mistakenly drawn against our account. So we're going to have to add back that $400. The last one, E, the bank statement shows an NSF check from a customer that the company has not yet recorded this check. And so our E is an NSF check, and that NSF check was for $600. So now we'll grab our calculator over here, and we'll take $25,800 plus $6,200 plus $400, and that kind of lots of times they put in a little subtotal here of $32,400. We're going to subtract our outstanding check of $5,600, and we're going to end up with an adjusted bank balance of $26,800. Okay. Over here on the book side, we didn't have anything that we wanted to add, so it's still $27,500. So from our $27,500, we're going to take out the $100 and the $600, and we're going to end up with an adjusted book balance at $26,800. And so we can double rule these because they are then equal on both sides. But we're not finished. Everything over here, we wouldn't have to do anything on the bank side. The deposit in transit will show up in June. Hopefully the outstanding checks will clear in June. But this bank error here of $400, this one's going to cause us to notify the bank of its error. We don't have to do anything in our accounting records because we didn't do anything wrong. This was a bank boo-boo, and so we simply notify the bank to have them put the $400 back into our account. However, everything over here, we're going to have to make an adjusting journal entry. And so we're going to debit either bank fees, or lots of times we look at miscellaneous expense. So we're going to either debit miscellaneous expense. Some companies like bank fees, kind of a choice of the company, but that's what it's for. So we're going to debit that for $100, and we're going to credit cash for $100, and we usually make each one of them separately. This NSF check, we're going to debit accounts receivable, whatever our, and they didn't tell us, but the customer name, and credit cash for our $600. And that will bring our books that say has a balance of $27,500. After we post these two journal entries into our general ledger accounts, the cash balance will show up at $26,800. So between video 1 and this video 2, we've covered all of the information as far as Chapter 6 is concerned. So part of it falls on to you to read the chapter about internal controls, read the chapter about cash and how we handle cash by mail and cash on hand, and the next videos we'll start looking at then will be on our Chapter 7.